Millions of Americans are now using Klarna, Afterpay, and Affirm to finance groceries, gasoline, and clothing. These items people used to easily be able to afford.
Shopping experience surging in popularity. You've probably seen it. Buy now, pay later.
Afterpay, Klarna, Affirm, and more. Quick to get you approved, no hard credit check, and pay it off in 4 interest-free installments.
But here's what no one's telling you. Starting this fall, all 3 major credit bureaus, TransUnion, Equifax, and Experian, will now begin to report this data. And this will impact millions of Americans' credit scores.
Choosing the buy now, pay later option could affect your credit scores. FICO, the company that developed the most widely used U.S. credit score, has plans for a new credit score model. It factors in buy now, pay later loan data to evaluate credit worthiness.
That $35 Sephora split payment, that $85 Target run, you miss a single one of those payments and it will show up as a late payment on your credit report, dropping your score upwards of 180 points. This could get in the way of people getting a mortgage, a car loan, a business loan, or any type of help. And that's not all. Credit card debt is at record highs.
Americans' total credit card balances now stand at a record high $1.2 trillion.
Card delinquencies are rising and credit is tightening.
So many folks are drowning under the weight of credit card debt, as the number of accounts with delinquent balances has more than doubled since 2021.
In this video, I'm going to show you what's really happening, why this is way bigger than buy now, pay later, and why millions of Americans should be thinking of how they can get ahead of this credit crunch that's incoming. Buy now, pay later used to be an easy way out. Can't afford something today? Break it down into 4 easy payments. No credit check, no problem, right? Well, not anymore. It's turned into a trap. And this trap is about to hit millions upon millions of Americans' credit scores. FICO just announced that they are going to begin to issue this data to the credit bureaus in the matter of months.
FICO, the big credit score company, announced it'll start factoring these types of loans into scores this fall.
For the first time ever, grocery store runs, gas bills, and even that Uber Eats order that got financed into easy payments will now show up on their credit report. And this isn't just theory. Affirm posted a 17% default rate on their buy now, pay later loans. That's nearly 1 in 5 Americans that are missing payments.
More Americans are turning to buy now, pay later finance plans to pay for groceries. And more people are struggling to pay those loans back.
41% say they've made a late payment on their buy now, pay later loans.
And this is happening at the same time that credit card companies are reporting sky-high outstanding balances and record debt. Interest rates on most credit cards are north of 20%, and on retail credit cards north of 30%.
They carry a higher interest rate, like you said, as high as 36%. The average is about 30.4 as of September. It's about 20%, right? Usually for a regular credit card?
Yeah, and this is per bank rate, I believe.
And as that's happening, inflation continues to eat away at Americans' paychecks. Buy now, pay later is no longer a convenience. It's turned into a lifeline. And that's where it gets dangerous. Because what used to be an easy financial lifetime has now turned into impacting one's financial reputation. And if you're already struggling, this is going to make it even harder to borrow, harder to buy a home, and harder to get ahead and get access to other lines of credit. And it's not just buy now, pay later. It's part of something much bigger, something most people have not realized yet. Because what's coming is a credit crunch to the magnitude in which we've never before lived through. The signs of this are everywhere. If you think credit was already tight, just wait. The entire system is closing in on the average American family. Auto loan delinquencies just hit the highest point in over a decade. As of Q1 of this year, 7.7% of all auto loans are in delinquency, 60 days past due or longer.
According to Experian, 60-day auto loan delinquencies at an all-time high.
That's not just a stat. That's a family losing access to transportation, how they drive their kids to school, how they get to work, and of course, how they pay their mortgage or pay their rent. Meanwhile, credit card balances are hovering just over 1.3 trillion, with interest rates supporting that balance over 20%.
Credit card debt, where Americans borrowing more than $1 trillion. Are you honest about it?
People are maxed out and banks and financial institutions know it. That's why they're pulling back, and a lot of very large corporations, financial institutions, are looking to cater to the ultra wealthy. Look at JP Morgan Chase, look at Goldman Sachs. They are now bringing out entire divisions to serve the rich. According to the Federal Reserve's most senior loan officers survey, banks have tightened up credit standards for mortgages, home loans, auto loans, and personal loans. This is the highest level since the 2008 Great Financial Crisis. And this brings us to housing. Because when credit gets tighter, fewer people can get approved for home mortgages. And the ones that do end up paying thousands of dollars more in interest. A home buyer with a 620 credit score is paying over $70,000 in additional interest payments on a $400,000 home purchase than a borrower with a 760 credit score. That's the real cost of bad credit today. So if you're financing food through buy now, pay later, struggling to make your car payment, and carrying high interest credit card debt, you're not alone. But this is the exact profile of the individual that the system is trying to shut out. And they say it's not personal. This credit crunch is spreading fast. And what's happening next could hit the housing market in ways that most Americans are not ready for. You might think homeownership offers more safety, but even that's starting to crack under pressure. Right now, mortgage delinquencies are rising. According to the Mortgage Bankers Association, the last 3 quarters, mortgage delinquencies have increased quarter on top of quarter on top of quarter. It's not 2008 levels, but it's not moving in a good direction. Why? Because inflation didn't just raise prices, it changed everything. Property taxes, home utilities, property maintenance, you name it. Even if your mortgage is fixed, the cost of living in that home continues to go up. In places like Florida, home insurance has more than doubled since 2020. With the average insurance policy north of $4,200 per year, and in coastal regions north of $10,000 per year for just home insurance. And the pain doesn't stop with current homeowners. Buyers are struggling too. With mortgage rates hovering around 7%, purchasing the average price home has increased by about $1,200 per month over just the last several years. But here's the kicker. Over the next 1 to 2 years, you have roughly $2 trillion worth of commercial, office, and multifamily debt that is coming due. This includes everything from small multifamily properties with 5, 10, 50, and 500 units to office buildings and nearly everything else in between. Most of these loans were taken out in 2020 and 2021 when people saw this as free money and that rents were going to continue to increase. Many of these investors acquired these properties, and as they did it, insurance kept going up, vacancies got worse, and interest rates skyrocketed. Now a lot of this equity they thought they had in their building is no more. And due to this, when the expiration of their loan comes due and they call for a refinance, the bank is going to send out an appraiser. They're going to look at the income of the asset, they're going to look at their expenses, and there's going to be a really good chance that many of these people will not be able to get a new loan because they don't have the equity in their deal. Meaning, many are going to turn the keys back to the bank, and it's going to be a bloodbath in commercial real estate. If you were a lender, how conservative would you be knowing that the loan in which you would issue on this property will likely be offset by rising costs in the coming few years with a slim likelihood of rent increases? This is the pressure cooker that we're now living in. From personal credit to property debt, the entire system is being repriced. And that repricing, it's starting to break people. So here's where things get even more dystopian. Starting this fall, Buy Now, Pay Later will now begin to be reported on all 3 major credit bureau reports and FICO. That might sound like a good thing at first. Klarna, Afterpay, all this positive payment history could impact your score in a positive way. But here's the problem. Most Buy Now, Pay Later customers are low-income, high-risk borrowers. And as banks begin to take this information, they may have a new credit profile on that user. Most people that are using Buy Now, Pay Later to finance groceries, gas bills, utility bills, and very small expenses.
New data is showing that a growing number of American consumers are using the payment method for everyday items.
25% of Americans who have Buy Now, Pay Later loans are using them to help afford groceries, and that number is up from 14%.
Are people that generally are going to offer that bank a lot more downside risk than upside. And this trend isn't just growing, it's breaking. One of the largest Buy Now, Pay Later platforms just announced 17% of all of their customers do not pay back their money that they borrow. Now imagine this, you're someone that used Buy Now, Pay Later to get by during the inflation crisis. You missed a few payments, maybe 1, maybe 2, or your paycheck came through a little bit late. Now that gets fed into your FICO report. And suddenly, that new car that you want to get, that new home, or potentially that new job, they all have access to that information. And let's not forget, FICO isn't just used by big banks. Landlords, insurance companies, and employers all take this information. They look at your credit profile and they determine who you are as an individual, an employee, and a consumer. They're looking to dial in and see how trustworthy you are. If buy now, pay later becomes a trap, it could effectively lock out millions of Americans from upward mobility and getting ahead. It's a financial sorting mechanism and it's tightening. Right now, banks are quietly pulling back. Credit is getting harder to get, especially for low-income Americans. Even people with decent credit are seeing denials on auto loans, mortgage rejections, and even small credit increase requests on their credit cards. Lenders are really scared right now. Why? Because consumer debt is now sitting north of $17.6 trillion. And delinquencies are rising across the entire board. Auto loan delinquency is now at the highest point in over a decade. Credit card delinquencies hit 9.5% for subprime borrowers, and this number is continuing to climb month after month. Student loan repayments starting this year only made things worse.
Just last month, President Trump announced that collections would resume beginning May 5th.
Many borrowers are struggling to make multiple payments and continue to fall behind.
More than 5 million people are already in default on their loans, meaning they haven't made a payment in more than 9 months. And another 4 million are in late-stage delinquency and could soon be in default.
And when Americans start to continuously miss payments, banks continue to take risk off the table. With credit tightening and debt piling up, getting a mortgage today isn't just hard, it's borderline impossible for millions of Americans. Even if you have a good job and a solid credit score, lenders are growing even more cautious. They want bigger down payments and a lower debt-to-income ratio when qualifying for a loan, and are really targeting consumers that have pristine credit. If you're carrying student loans or credit card debt, you'd already be at a big disadvantage. This is according to a recent report. The average monthly mortgage payment is now $2,900. This is a 90% increase since 2020. Mortgage denial rates, they're rising. And with FICO's new model of including buy now, pay later data, that will likely work against consumers and be for the benefit of large banks and financial institutions issuing loans. And here's the kicker. Home ownership in America used to be the dream. Now it's becoming the rich man's asset class. First-time buyers are getting priced out, while Wall Street and big investors are buying up entire neighborhoods. We're not just in a credit crunch, we're in a confidence crunch, where consumers don't know who to trust. Lenders are playing defense, and the average American, they have their back against the wall. Everywhere you look, the pressure is building. Debt is up and payments are late, and access to credit is continuing to shrink. And even now, those buy now, pay later purchases, those $60 sneakers, or an impulsive grocery store run could trail you for years on your credit report. So where do we go from here? If you've got great credit, you need to play it safe because the rules are rapidly changing. If your credit is average or bad, now is the time to fix it. Stay on top of it. Check your credit reports daily and make sure that everything is accurate and true. The financial system is not going to give you the benefit of the doubt. They are looking at every single American very, very, very closely. What are your thoughts on this entire situation? Do you believe we're walking into a massive credit crunch inside of this country that will push out the bottom 95% in the financial pyramid, benefiting the top 5%? Because what is a home worth? Home is worth not what a seller asks, but what the highest ready, willing, and able buyer is prepared to pay. If these 3.5%, 5%, 10% down mortgages that were being absorbed by low credit score borrowers starts to fade away, we could walk into a situation where there's a lot less buyers willing to overpay for a property. And we're already kind of seeing that now, but just imagine as this credit crunch amplifies, we could see some real big changes. Let's have a conversation below. And for more information on what I'm doing in Cleveland, I believe affordable housing is going to be a great investment the next 5 years as we begin to see millions and millions of Americans migrate towards affordability because many won't have any other choice. Let's have a conversation below, and if you have $500K in cash or more, you can click the link in the description, and I'll catch you in the next video.